S. Naren, Chief Investment Officer with ICICI Pru AMC, joins us live from his Mumbai office. Naren, good morning. Thank you for joining us. Naren, corrections, they always look painful, no matter how deep they are. What do you make of last week's price action? Everything has got shredded apart.
Yeah, actually, the market fall after the Fed conference call was rather striking. But at the same time, we always believed that something like this had to happen over the course of the next 15 to 18 months. And when it would happen was a question mark. So from that point of view, I would say that as the market adjusts itself to the fact that quantitative easing becomes a certainty, then I mean, reduction is a certainty. I think it would help the entire world economy also eventually.
Naren, at a time when we will be staring at a tight liquidity environment, a strong dollar and weakness in commodities, what should one do? What should one buy, avoid and hide into?
See, I think one is from a long-term angle, these are the kind of periods where people should increase their allocation to equities. Over the last 2 years, if you've seen, there's been continuous FII buying, and that was one of the deterrents to big increase in equity weightage, because many of the stocks that they were buying, they looked fairly expensive. Now we are in a phase where FIs are selling local, with the exception of a few insurance companies, the rest are selling. So the time to buy for the long term has really come. And I'm not saying that market will go up tomorrow or something like that, but I'm saying that whatever we like to see for investing or long-term investing in equities, which is complete pessimism, people having complete doubt on markets, I think that phase has started, so people need to look at it. From a sectoral perspective, as you know well, we've been negative on consumption, we've been positive on exports. And we believe that once the export story happens, then the infrastructure story should pick up. So that has been our standard view, and that continues for the past quite some time. And we continue to believe that that is what we believe in. The consumption slowdown has not been as stark, and in our reading, till that slows down, you're not going to see the current account deficit come off substantially. And then you will have the rupee problem there. And so I think clearly you've got to bet on exporters. There is no choice there. We have to bet on a wide variety of exporters for the long term.
Naren, what's your sense on this whole IT trade? I mean, at a time when IT companies have themselves come out and said that this near-term benefit is only going to last that much, and eventually it is the rupee volatility which does affect IT companies, and that too negatively, we're not really seeing that translate into stock prices, because relatively we've seen the IT sector actually outperform when it comes to equities.
But look at the kind of underperformance that they've had, and our belief is the best macro trade for the next 3 years would be the export trade. And if I had to look at the export trade, what are we left with? We are left with technology, we are left with pharmaceutical and a few textile and auto ancillary kind of companies. So I think there is no choice for India. You can't have $180 billion trade deficit sustaining. So you have to bet on the exporters. So I think export sectors like technology are likely to outperform. There could be stock-specific declines based on what happens in the June results. But I think as a sector, I don't think we have to worry about the sector.
Last time when we interacted with you on this forum, you were hot on commodities, and your view was that, look, commodity stocks have fallen really hard and there is a tactical trade there.
Yeah, actually, in the case of upstream oil, they have been defensive in this fall. But the other commodity stocks have fallen with the market, in some cases even more than the market. Our theory has been that today we are in a situation where if I have to export, maybe the next sector where people will be forced to export will be the metal sector. Because, you need to bridge the gap. And if you don't have other sectors to bridge the gap, I think it is going to happen in agricultural commodities and metals. So these are two sectors which will see maybe exports going up, and people are not recognizing that the dollar rise has taken care of the complete commodity fall in most of the commodity stocks. But in the way the market looks at it, the market has fallen, with the exception of upstream oil. The stocks have fallen substantially in the last 1 month. So I think from value, it's become deeper value right now.
In the run-up to 2014 elections, do you think markets are likely to remain nervous, or with because of some policy action, some development talk, markets could really propel up?
I think the combination of how QE withdrawal results in what changes in the world, coupled with political uncertainty, I think the combination is a heady combination for volatility. And we're going to see fantastic, unfortunately, a lot of volatility in the next 1 year. And as fund managers, we are actually ready for the volatility, because we have seen in previous times also, both 2004 and 2009 were both fairly large years for volatility. There's no reason to believe that 2014 won't be volatile. So I think we as fund managers are ready for it. We have worked on our investment process to handle the volatility, because I think that's going to be the feature of the markets.
Naren, what's the call on the FMCG space, especially in light of the Unilever open offer?
See, we've been underweight for more than 12 months, and it's not a call which has worked for us. But having said that, I think the sector is bizarrely overvalued at this point of time. And in the way people looked at it, they assumed a global cost of capital and invested in a depreciating currency. And due to that, deals have happened which are not in tune with the current environment, where global cost of capital is rising and currency has also been depreciating. So I think this kind of an overvaluation has to correct. In my market experience of 20 years, I have not had a situation where if you invest in 35 to 40 PE, trailing PE stocks, you made money in the next 3 years. So I still continue to believe that you can't make good money in consumer staples, because in the last 5 years, what has happened, it's not that earnings have gone up. Earnings have also gone up and PEs have got re-rated. In fact, the PE re-rating on a yearly basis, what we have discovered is more than 10 to 15% per annum. So which means in the last 5 years, the price to earnings of the sector has gone up by about 75% to 100%. That's simply not sustainable.
Right. Naren, so when will that turning point essentially come for markets, where the defensive trade will crack and the growth trade will make a comeback? Because, markets have been betting on this growth trade to come back for a while now, but the growth trade is yet to make a comeback.
See, I think basically we want to see first current account deficit fall, and I think that would involve a fair amount of slowdown on the consumption sectors. And I think while the government has taken some fantastic action on the gold side to reduce the consumption, I think we have to see that slowdown in consumption. Maybe it will happen in the course of the next 3 to 6 months. And once that happens, if you ask me, without a good sizable investment acceleration, you can't have a market rally, and I think that has to happen following that. In between, you have the election cycle. So the whole thing is, if you ask me to bet on when the entire turning point will happen in the market, it will happen maybe just after elections or something like that, because otherwise you're going to have election plus change in market leadership, which may not happen at the same time.
Naren, what did you make of the big deal in the tyre space? And at large, what is your view on tyre companies? And do you think the big deal that we've heard of in the recent past, we've seen the kind of market cap erosion and the premium that the deal has been struck at, do you think that's justified?
I think we have seen different kinds of overseas acquisitions. We've seen some auto acquisitions which happened in 2008. We've been very, very beneficial for the buyers. Whereas we have seen some other acquisitions which have not been beneficial. For example, we have seen a few auto comp acquisitions which have been very good for the buyers. So I think what we have learned as fund managers is that it's very difficult to correctly predict what would happen post the acquisition, because in some of the cases it works, in some of the cases it fails, and consequently as domestic fund managers, what we do is we reduce the weightage in those stocks, because we are not able to predict what will happen to those companies.
Narendra, do you think we have a economic bottom in place, Narendra, or do you think the marginal rate of change still could disappoint going forward?
See, our view has been that the moment you have a monthly trade deficit for 3 months of around $12 billion a month, then you have reached that economic bottom that we want to see. With a trade deficit of $20 billion, I don't think we have reached the economic bottom, because you need to have trade deficits of 12 to 14. It can't be ahead of 14, because once you have more than 14, your current account deficits are large. So I think we are some time away from an economic bottom. What people fail to recognize is the fact that we have had a good start to the monsoon, notwithstanding the problems that we've seen in some parts of the country like Uttarakhand. If the monsoon continues to be very good, one of the worries that we had for last year, which was that the monsoon started very badly, is not there this time. And the market is not at all focused on the monsoon, as you would have seen over the last 15 days, which is normally a good sign. Otherwise, like last year, there have been periods where people just didn't focus on the monsoon. Monsoon was doing badly, but the market was going up every day. Whereas this time monsoon is doing well, and people are not focused on the monsoon at all. They're focused on only what is happening globally. So I think clearly the long-term phase, I think this is the time to increase equity allocation. Period. I think whatever I like to see for increase in equity allocation, which is extreme pessimism, correction in valuation, in fact excluding about 10 stocks, the rest of the markets are very, very reasonably valued. I think we have a positive chance that in the next 2 years you will see a revival of the growth and investment cycle. So in fact, when we were doing the numbers, we found that some of the data, except that the current account deficit has not corrected, is coming closer to 2002. And we saw that the rally started in 2003. So we are possibly maybe a year ahead of the rally. And this is the time to accumulate for long-term investors. If you go back and see the data in 2002-03, you'll find most of the data is looking very, very pathetic. But that was the time to invest in equity. I think the next 1 year is a period where some of the data is not going to look good. But that is the time to actually increase allocation to equities.